And I think the reason they've done well, even though the amounts and the figures didn't seem huge, is because these markets are so leveraged in terms of paper that you just need a consistent physical buying from a fairly large counterparty, i.e., the Russian state, to affect the price. I think it just goes to show how leveraged it is. And David Jensen, I've had on my channel, he's spoken about how the LBMA is like the silver OTC promissory note spot contract is hundreds of times like leveraged.
On September 30th, 2024, the Russian government announced plans to allocate up to 51 billion rubles, equivalent to approximately $535.5 million, over the next 3 years to expand its precious metals reserves. While the move didn't grab headlines in the West, it marks a strategic pivot with broader implications. Veteran analyst Mario Innecco notes that Russia has reportedly been accumulating not only gold, but also physical silver and platinum. The volumes might not seem significant, but in thin, heavily paper-leveraged markets, consistent sovereign buying can move prices and expose the fragility of the system. According to a statement cited by the International Migration Agency, Russia's Ministry of Finance said that building refined precious metal reserves within the National Fund will help stabilize the federal budget, support economic development, and ensure the country can meet industrial demands in emergencies. While the budget draft lacks details on how these metals will be acquired, some analysts suggest that if silver is officially recognized as part of Russia's foreign exchange reserves, it could reignite investor interest and reposition silver as a monetary metal. Innecco highlights that Russia already holds significant physical gold, not just as a reserve, but as a strategic asset. That posture became even more crucial after the country's foreign exchange reserves were frozen in 2022. Unlike fiat currency, gold doesn't carry counterparty risk, it can't be sanctioned or seized, and it operates outside the reach of traditional financial constraints. For Russia, gold has become a monetary tool, a hedge against geopolitical pressure, and a means to preserve sovereignty. Russia remains the world's second-largest gold producer, trailing only China, with annual output exceeding 300 tons. Although the Central Bank of Russia once ranked among the top sovereign buyers of gold, its official acquisition slowed after the full-scale invasion of Ukraine. In contrast, the People's Bank of China has continued aggressive purchases, strengthening its position as a dominant player in the physical gold market. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Economic monetary situation hasn't changed. We've seen M2 in the US make new all-time highs. So in my book, that's monetary inflation. It's going to continue. We've got the Fed meeting starting tomorrow and ending on Wednesday. Markets don't expect anything from the Fed, but you never know. The fact that Trump has done a deal with the EU and is postponed the tariff implementation for the Chinese tariffs for 90 months, that might make the Fed a bit more comfortable in cutting rates. The other thing I haven't really been looking at too much, and that's more the geopolitical aspect. And probably because here in the UK, they've censored a lot of stuff since the Ukraine war started. For example, where we don't have access to RT anymore, RT news in Russia. But someone in Switzerland today told me that they have access there to RT. And apparently yesterday, President Putin or the Russians, they had to cancel a naval exhibition in St. Petersburg because of a threat of drone attacks, or there were drone attacks. Apparently they came from Ukraine, but apparently coming from the Ukraine would be really difficult to go all that distance to the Baltic, because St. Petersburg is in the Baltic. So this friend of mine thinks they're provoking Putin and that it's NATO. So I think that's really serious, and we're not hearing much about this, uh, not even in the alternative media. Confrontation between NATO and Russia, and that would be very serious. And you want to have gold and silver, especially in that situation. It's not why I have been stacking gold and silver, but it makes it even more necessary, I think.
Yeah. And many people forgot about this, but around this time last year, Russia set up a silver reserve. And if you look back at the price of silver about a year ago from today, it was $27. And today it's $38. So they set it up. We haven't heard anything from it. Have you gotten any updates in regards to their silver reserve that they were accumulating supposedly?
Well, they gave a number that they would buy every month, and I didn't think it was that much, but they also doing platinum as well. So it's
Interesting.
silver and platinum, and so platinum is also running, doing well. Well, they gave a number that they would buy every month, and I didn't think it was that much, but they also were doing platinum as well. So it's
Interesting.
silver and platinum, and so platinum is also running, doing well. And I think the reason they've done well, even though the amounts and the figures didn't seem huge, is because these markets are so leveraged in terms of paper that you just need a consistent physical buying from a fairly large counterparty, i.e., the Russian state, to to affect the price. I think it just goes to show how leveraged it is. And David Jensen, I've had on my channel, he's spoken about how the LBMA is like the silver OTC promissory note spot contract is hundreds of times like leveraged. Silver outperforms, and then platinum, and then gold. But as I tell my viewers, because they ask, should I sell silver to buy gold? And I say, if you want, but I try to just get rid of spare fiat to buy both. But I guess you could buy more silver now than gold, or you could go through the mining space as well, to leverage. If you're into that kind of stuff, there's the silver miners as well. Yeah, that's right. Usually a rising gold price is the canary in the coal mine for price rises coming. I mean, if you remember in 2020, gold dropped in March from like 1,700 to 1,450, and then it took off to 2,000
Yeah.
in early 2020, 2021. And then we saw the prices rising, like the CPI. Right now, the CPI is kind of under control, but a lot of that currency and credit is flowing into financial assets for now. But when people take profit or whatever and start spending, it could flow back into the consumer price index. Yeah, and it's not just stocks and commodities that are making all-time highs and collectibles. It's also like cryptos and Bitcoin. I mean, I don't know if you get this on your YouTube channel, but I get it on the comment section. All this, it's a spam, but they're all pushing these coins, altcoins, and trying to get people into it. It's just crazy.
The U.S. money supply is climbing again. In June 2025, the Federal Reserve reported that M2, which includes cash, checking deposits, savings, and other liquid assets, rose to a record $22.02 trillion, marking a 4.5% increase compared to the same month the previous year. While that remains below the long-term average growth rate of 6.3% from 2000 to 2025, it is still the fastest pace of expansion since July 2022. This shift in direction is what matters because it signals a turn in the broader monetary environment. After a period of monetary contraction and tight policy, The renewed growth in M2 suggests the Fed is now leaning toward expansion. That shift is already impacting financial markets. Liquidity is on the rise, which brings both renewed optimism and increased risk. The U.S. stock market has responded in kind, pushing toward record valuations. But the question is whether this fresh liquidity will drive genuine growth or simply inflate new asset bubbles. Mario Innecco points out that both M2 and stocks are hitting record highs, and the Buffett indicator market cap relative to GDP is signaling an apparent overvaluation. In this context, a rate cut might not make much sense. It would only add fuel to an already overheated system. But if you're watching gold and silver, it's a different picture. A more dovish Fed would likely send precious metals prices higher, and technically, both markets are already setting up for further gains. Let's get back to the interview.
And I think Besant and Trump mentioned that they want to see the mortgage market get kick-started because what's happening is people who have long-term mortgages, they locked in during COVID at very low rates. They don't want to sell their homes because they would have to refinance at a much higher rate. So the real estate market is kind of moribund. And but like you said, they started cutting rates September last year. They cut by a total of 100. And the 10-year yield has gone from 3.6 to 4.4. So I think that's what the Fed is concerned about. They're concerned that if they cut too aggressively in the short end, you're gonna see the longer end rally quite a bit. It's going to affect their balance sheet because they hold a lot of treasuries. They're already sitting on hundreds of billions of losses. And it would actually backfire for the Treasury. The cost of financing interest payments would rise. But I would think Besant would understand that, having been on Wall Street as a hedge fund manager for so many years. I can understand why Trump doesn't understand that. He's not really a bond person. He's a real estate developer. So yeah, I think that's why there is division, and it doesn't make sense either to cut rates right now. You showed that chart of M2 making all-time highs. That's just going to fuel the growth of M2. We've got the stock market near all-time highs. I mean, the Buffett indicator market cap of all U.S. stocks to GDP is at all-time highs. I mean, do you really need to cut rates? It would, I mean, for us precious metals enthusiasts, that would be really, really good. And I think they might, because the technical picture is pointing to continued move higher, I think, in silver and gold. Yeah, I haven't really combed through all the minutes of the FOMC, but one of the major reasons is that the uncertainty surrounding the tariff program of President Trump, because it does raise prices, tariffs. It's not the foreigners that pay the tariffs. It's the importing company in the U.S., and they pass it on to the wholesaler, retailer, and the consumer. Yeah, so that's a kind of rising prices, and that could lead to higher prices elsewhere. And that's what the Fed is concerned about. They say they're concerned about inflation, but technically they're concerned about prices, because it's the Fed that really creates the inflation. But so they can't create the inflation right now because, yeah, the prices are going to be affected by the tariffs. But it hasn't been, these tariffs and the prices haven't been around that long. Need maybe at least 6 months to see what happens. So I think that's why the Fed's been waiting. Or some people could argue that they're being political, even though it was Trump who nominated Powell as the chairman of the Federal Reserve. If they were to raise the short-term rate, Fed funds target, yeah, that would actually probably, it will probably lead to a flattening of the curve. Yeah, the yield curve. That would mean that investors would feel more comfortable about the inflationary picture, and they would probably buy a little more in the longer end. And I saw, though, prior to coming on with you, someone posted on X that the inflation expectations, which is an indicator that traders use, it's at a really high level right now for the next 4 or 5 years. So it's not like a kind of environment where you'd expect rate cuts either. Trade deficit and current account deficit is running not because of foreigners, but because of U.S. corporations having outsourced everything to make a lot more profits. They hire cheap labor, and it's one of the reasons the stock market has stayed so elevated. So if you reverse that, it's a no-brainer that the stock market will come down, and I think that's why they backed down a little bit, and they're delaying these tariffs. They've just delayed the Chinese one for 90 months. So yeah, they've gone with this big, beautiful bill and tax cuts. Um, I mean, I've never seen it work. It might work a little bit, but I heard someone asking Trump a few months ago, the deficits are really high, the budget deficits, and your big, beautiful bill is going to make it even worse. And he said, oh, it has to get worse before it gets better. I've never, if I was me personally, my family, if we were in a lot of debt, I wouldn't try to get into more debt to get out of it. I would try to work harder, get children to work as well, and cut back, try to pay off debt. That's the only way you can do it. Yeah, and I remember a year or a year and a half ago, a lot of people, some analysts on X, they were posting the fact that inflation or CPI in the 70s came in waves, like 3 waves, like late 60s, early 70s, then mid 70s, and then late 70s. So yeah, there is this saying that inflation comes in waves. So yeah, we could be headed for that. Maybe it starts in October, ticking up, and of course they're going to find a reason that's got nothing to do with the Fed being too accommodative, because it is accommodative, even though they want rate cuts. They're going to find like an exogenous reason, like Putin or China, because they never blame themselves for it. The money printing and the M2 increase happened on Trump's watch in 2020. I'm not saying Biden was perfect, but the CPI rose later. I mean, when Biden took over, but the inflation, the seeds were planted by Trump. So this time he's president till 2028. So those seeds that are being planted now, yeah, they could come home to roost before the midterms. I mean, the only thing that is like a wild card is Jay Powell. I saw a comment today. Trump said Jay Powell is going to leave very soon. I don't know if he means that May next year is very soon, or if he's got something up his sleeves. I think that would be the only thing that might, well, he might think that will save him, because they'll come in, they'll replace Powell with someone, and they'll come and cut rates by 1% in one meeting. I think that could be really disruptive, though, for the markets, paradoxically, because whenever you cut like this aggressively, markets think, well, there's a problem.
What's unfolding isn't just a series of disconnected headlines, it's a coordinated reshaping of monetary priorities. Russia is anchoring its financial strategy to hard assets, placing metals like gold and silver at the core of its national reserve playbook. Meanwhile, the U.S. is quietly shifting gears, ramping up liquidity, and hinting at a softer stance on rates. These moves aren't just technical, they're signals. Both nations are responding to systemic fragility in different ways, one by insulating with tangible value, the other by fueling markets with expanding money. The common thread? A growing distrust in the durability of fiat alone. If central banks are turning back to metal and money is losing weight in real terms, are we witnessing the early signs of a return to tangible value as the backbone of global finance? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.